we falling behind the curve? Well, according to Anish's presentation earlier, we certainly are, but we want to delve into a little bit more detail about different perspectives from around the world. So I'm joined by 5 brilliant KPMG colleagues, bringing 5 different geographies. Do you want to do some quick introductions as to who we've got on the panel?
Yes, hello everyone. My name is Angie Gildea. I lead energy for the US.
Good morning, everyone. My name is Salami. I'm a partner in the tax division of KPMG Nigeria. I also double as the lead for energy and natural resources sector for KPMG West Africa. Thank you.
Hi, good morning, or almost good afternoon. My name is Sharad Somani. I'm a partner with KPMG in Singapore, covering Asia Pacific for energy and infrastructure sectors.
Hi again, I'm Apurba. I'm a partner with the ESG practice in KPMG in India, and I lead climate change within the practice. I also lead ESG government as a proposition globally for KPMG.
Good morning, everybody. Trevor Hart. I lead our global mining practice. I'm based in Australia, and really the mining story is where it all starts for us. So interested to really participate in today's panel. Thanks, Simon.
So we've got 5 different geographies here to give you different perspectives on the energy transition, but we also want your participation. So if it's possible to pop the first poll question up, if you can get your phones out, preferably don't get distracted by your emails, but do point them at the screen when the QR code comes up, and we'll get you to give us your views on what you think are the biggest risks to the clean energy transition. So if you can click on that QR code, or if you want to open Menti, you can do that on your phones as well. And you've got 5 choices there. It's policy and political risk, it's the availability of capital and financing, it's technology risks, it's distributional and fairness considerations, or it's investable and market opportunities. And I'm going to strain my neck by turning around and just seeing what the results are coming out as. If I can ask my fellow panelists to look at this screen, because I'm going to turn to you guys for a bit of commentary on this as we get the results in. Keep voting, guys. Seems to be a heavy weighting, I think, to the first of those categories, which doesn't come as any great surprise to me as a former government policymaker. We've got everybody's votes. Any surprise? Angie, are you surprised by that? Policy and political?
You know, I'm not incredibly surprised, although I think if I was going to vote, my biggest concern is balancing the sustainability with the affordability. And so for me, I would have voted for the yellow risk, because I think that's a huge risk of this energy transition, is we maybe progress at a certain pace and we leave a certain population behind.
It's edging up all the time as people, I think, are reflecting
I didn't mean
on that
to
point.
influence.
Maybe your influence in the audience. Any of my fellow panelists want to come in, Sharad?
Yeah, Simon, if you can take it. So I'm a bit surprised, although not totally out of sync in terms of what we are saying. I would have put probably number 4 as the highest consideration, particularly in the markets that we come from, which is the emerging Asia. I'll give you an example. We are working on the Energy Transition Mechanism Fund in Indonesia, Vietnam, and Philippines. And this is the most important aspect on how do you move away from coal, because 80% of generation is thermal in that region. And the aspiration is to probably move at least 30 to 50% over the next 10 years. But not only by doing clean energy projects, but also retiring thermal projects much faster than their economic life. And one of the key challenges is essentially just transition considerations, because there's a huge number of jobs at stake. And second is availability of cheaper blended transition finance, which is a big challenge in that market as well. So if you can tap on those 2 things, it will be very powerful.
So it may vary by country. Apurba, do you want to come in?
Yeah, no, I'm also somewhat surprised, because for me as well, I think finance would be probably the one that's on top of my mind. Because even if we have pivoted as a world in a way that, last year we spent more on clean technology than we did on fossils. So we are pivoting in that direction. But at the same time, the cost of the transition and at the pace that it needs to be enabled is so huge that we don't have committed finance on the table, right? And for a country like India, if you expect the public exchequer to pay for the transition, that has a huge impact on the GDP, on employment. And those are the kind of impacts that we can't ignore as a developing economy. So I'd say that the cost of the transition is huge. The financing will have to be enabled. And what Sharad said in terms of newer capital structures, in terms of blended finance, or as an economy, innovative models of, say, taxation in terms of carbon taxation, all of that would have to enable it in a big way.
So these results might vary by country. I'm going to, Angie, come to you first, just because we've just seen their policy risk is a major factor. Probably the most significant policy development has been the Inflation Reduction Act in the US over the last year. We feel the gravitational pull of that from Europe. Tell us your perspective from the US in terms of what that's doing for clean energy investment.
Yeah, well, maybe let me just level set on what the IRA, or Inflation Reduction Act, is for everyone. So the IRA is in conjunction with what we call the IIJA, the Infrastructure Investment and Jobs Act. The IRA is a $390 billion bipartisan investment towards clean energy. The IIJA is a $1.2 trillion bipartisan investment towards upgrading the infrastructure. So it's the power grid, but it's also roads, public transportation, et cetera. So that represents, first of all, those are huge dollars, but that represents the largest climate and energy policy investment ever in the history. It also represents the largest investment towards infrastructure that the US has made since the 1940s after World War II to electrify rural America. And so why did we do this? Well, we did it for a couple of reasons. One was to progress the US's commitment towards net zero and our commitments with the Paris Agreement. But also, we see this energy transition coming, and we see it as inevitable. We also see that the US has benefited for several decades now on energy security. We've been blessed with a large number of resources, and with the shale revolution and the oil and gas development, that's something that's really been benefited for the US. And so if you look forward to the energy transition, what we wanted to do as a country was, first of all, foster the innovation and development of clean alternative energies in the US, and then also make our supply chains less dependent on geographies which there's conflict with the US. So how can we bolster the supply chains in the US and North America and compete, frankly, with China? And so that's what the package has done. There's two parts of the package that I think has been interesting and a benefit for how the US rolled this out. The first part is around tax incentives. So about $260 billion, so over half of the IRA is dedicated toward tax incentives. And those tax incentives are tax credits that are transferable and can be monetized. So you get a certain percentage of tax credit for new energies. You get an additional percentage off if you can tie it to what we call prevailing wage and apprenticeship. So if you can show you're building skill sets in the workforce in these clean energies, you get a higher tax credit. The other roughly half of those components is around funding by the Department of Energy, and that's in the form of loans or grants around clean energy. So we're coming up, we've just passed a year. It was enacted in August of last year, so we've hit a year. I think we've seen some really great benefits, Simon. The first of all, one of our benefits is over $1 billion in DOE funds have been committed towards our power utility infrastructure. And that's really important because if we're going to electrify the US and move towards EVs, for instance, we have to have a power grid that supports that. So that's been a big component. The second component is on the EVs. We've had about $72 billion in I'll call it the EV sector, which is a combination of incentivizing building manufacturing plants for automakers to produce EVs. Also battery plants manufacturing, battery recycling. And we've seen an uptick. We saw in the first quarter of 23 an increase in about 54% in EV sales. So that's seeming to progress. We've also seen the pipeline now of battery projects in the US exceed a growth rate in excess of what we see in Europe and China from a pipeline percentage. So we've seen some really, really great things. There's also obviously some challenges and things we have to look ahead. But $1.2 billion, I should say, in hydrogen and another $880 million in carbon capture. So the money's getting out there, and we're starting to really see some wonderful results.
Yeah, huge, huge impact, I think, and a global impact too. Angie, one of the questions my clients in Europe ask me is, so if Trump wins next year, is he going to get rid of the Inflation Reduction Act? Are all these tax credits going to go? Tell us what the answer is. What's the advice you give your clients on that one?
Yeah, that's a very good question. I get that here a lot. We also get it in the U.S. I'm not I don't have a political crystal ball, but I can tell you this. If you look at where the funding has gone, 80% of the funding has gone towards what we call red states, so Republican majority states. I think it's going to be very difficult once those projects have been announced, the jobs have been created, people are getting excited. I can't predict exactly what will happen, but I think the Republicans would come under some significant pressure from their own constituents if they tried to roll some of this back.
So he's not going to knock the factories down then if he wins. So I think that's a good answer. Apurba, can I bring us closer to where we are today in India and India's energy transition? Because in a way, what I've heard has been a desire to kind of try and dominate some of the supply chains as well from India's point of view, create the jobs, create the investment here in India, become self-sufficient in energy. Tell us about where your perspective on that energy transition as it stands at the moment.
Thanks, Simon. I'd just like to start by saying I think the growth and development story for India is really quite a complex one. Right? We're one of the fastest growing economies. At the same time, we have the largest population in the world now, and a rapidly urbanizing population, right? We're also a rapidly industrializing, economy, like Anish mentioned in his opening. The fact that we're transitioning from an agrarian economy to an industrialized and services-based economy. So that's also a big transition. We also have the largest number of the world's poor, right? And those with the least access to energy. So these are multiple developmental imperatives. But all of these developments, they put a huge strain on our resources and on our energy demand. In fact, in the next 2 decades, India's energy demand will be 25% of the world's energy demand. So that's huge. And that also is a big challenge for us when it comes to what you said, achieving self-reliance, or what we call Atmanirbhar Bharat, like relying on our own resources, right? So that's a huge challenge. But having said that, I think it's also important to acknowledge that India's renewable journey, especially in the solar and wind space, has been quite phenomenal. So in the last couple of decades, we've seen growth that analysts never expected 2 decades back. So that's been a phenomenal story. Started with wind and then with solar, and largely driven by policy incentives and regulatory pressure as well. So for example, we had the renewable purchase obligation that came in. There are a variety of incentives that have been introduced around, for example, waiver of transmission charges interstate, or when it comes to manufacturing, the PLI scheme or the performance-linked incentive schemes. So, and there are a couple of learnings there as well in terms of, and historical learnings in terms of, the fact that perhaps our solar ambition was at a much faster pace than our industry could develop. So that's another learning in the sense that perhaps we need to pace it such and provide the right set of incentives for the domestic manufacturing ecosystem to develop as well. So at the moment, a large part of our capacity that's there on the ground is very dependent on imports. Because if you look at the value chain of solar, specifically going from polysilicon to wafers, that's the part of the value chain that we're missing within the country. So that's a significant challenge. Also, it's important to acknowledge that coal will continue to be a mainstay, right? Today, coal is the dominant power source within our grid. And it will continue to remain so for a variety of reasons, one being the fact that we need the baseload power, we don't have a lot of natural gas peaking capacity, perhaps we need better scheduling and forecasting, we need better or enhanced energy storage for the grid, before which renewables could, before renewables can be penetrating to that extent that it can replace coal entirely. So I'd say coal continues to be a mainstay. But having said that, it's not just the power sector. When you talk about the energy transition for the country, it's beyond the power sector. If you look at industry, it's only, electricity contributes to only 20% of the industry's energy demand. The rest of it is process heat. And that's the part that's harder to decarbonize. So, major industries for us like iron and steel, cement, these are major parts of our manufacturing. All of them require futuristic technologies like hydrogen or say biofuels. And other technologies like energy storage or the electric mobility transition, these are all very important transitions, right? And also if you're looking at heavy duty freight and logistics and maritime and aviation, all of these are important transitions from our perspective. And there are challenges there in terms of when you talk about batteries. In the morning we talked about the availability of critical minerals. Or when we talk about say hydrogen, it's also about the fact that there are still some trade barriers and the fact that there are severely heavily subsidized markets like US and China that we're competing with. So there are challenges. On the biofuel side, land is a finite resource, so it's a challenge. But we're moving in the right direction with the right intent, and I think that's what's important.
And tell me, how are ESG considerations being factored into the companies that you're working with in India? How large are they looming in terms of corporate boardroom and decisions?
Simon, this is my second stint with KPMG. So I was here with KPMG around 13, 14 years back when we had first set up the practice on ESG specifically. And the world was very different then, right? So there were just like a handful of companies that were disclosing, so they were just reporting. And a lot of companies that were investing on climate for the primary purpose of getting additional funding from the voluntary and mandatory markets at that time, like for example, the clean development mechanism that existed. So that was it. But ESG was not a mainstream boardroom conversation topic at that moment. And the world has changed, India has changed, and in the last 1 decade, it's been a sea of change. Because now we have regulation, when it comes to disclosure, we have something called the Business Responsibility and Sustainability Reporting, which is fairly extensive and requires companies to gather data across not just their own operations, but across their supply chains. So disclosure has come in a very big way. Companies are now being rated with their peers because a whole lot of rating agencies have mushroomed. So it's keeping the corporates on their toes. And at the same time, this ESG has become a boardroom conversation. And if you talk about material issues, I haven't worked with a single client where climate change is not one of the top material issues. And how do you deal with that is, for example, if you're a services sector, then you're switching your power source. If you're an industry, then it's perhaps harder to decarbonize. But this has been a very big driver, I would say, in the transition to cleaner energy in the recent past in India.
Fascinating. Right, we're going to take a short hop on a plane that's obviously fueled by sustainable aviation fuel to Southeast Asia. Sharad, give us the perspective. An area that's heavily dependent on coal and gas. Tell us about the perspective on the energy transition from Southeast Asia.
Yeah, so I think to appreciate Southeast Asia, we should know that this is a 600 million population region, probably 7th largest economy if it was an economic bloc, right? So it's, and fastest growing, probably stronger growth rate than India. One of the things that comes to mind is what happened in China probably in late 90s, early 2000s, what's happening in India over the last 15 years. The demographic dividend is going to happen in Southeast Asia over the next 15 years. So when we talk to policymakers, the energy security and affordability is probably on the top of the agenda before we go to the sustainability, right? And this effectively means that we will continue to rely on thermal, cheap coal, and wind and solar will continue to come in as long as it has grid parity. The green hydrogen roadmap, the biogas is all at a very, very strategic level. Right. One of the interesting things that happened when we were working in Indonesia is we were asking them to shut down coal and commit to dismantling the coal projects because we are getting them blended finance. And they told us, hey, Germany is restarting the coal plants, so what is the guarantee that 20 years down the line we wouldn't require our coal plants as well? So how about we mothball rather than dismantle? And that is the policy consideration which is becoming very, very important, isn't it? So while the basket of fuel options that Southeast Asian countries are looking at is all available, and we are not talking much of nuclear as yet in that region, but this morning it was interesting to see SMR being talked about, and this is something which clearly is on the policy agenda. So if you look at the 2050 energy sector decarbonization roadmap that was published by Singapore, we are talking of all the options being on the table, including nuclear, subject to security, safety considerations. So I think to answer your question, there are a lot of R&D happening, there are a lot of investment dollars being put on green hydrogen pilot projects, some SMR discussions have started, biogas pilot projects are being initiated. There is a sustainable aviation fuel pilot being implemented at Changi Airport already. So there are multiple initiatives, but all these countries are waiting for technological breakthrough and blended finance being made available for them to transition without compromising on economic growth.
It all sounds quite early stage, and obviously waiting for maybe the policy frameworks to be there and the innovation to come through. Are there any use cases that you'd highlight that are at scale, that are really noticeable in the region that you'd definitely point to as a way forward?
One of the interesting things happened, if you look at Southeast Asia, the different geographies have different resources, right? So Vietnam implemented 16 gigawatts of solar, and now they are not able to dispatch it because the grid is constrained. There's a fair bit of geothermal in Indonesia and Philippines. There's a fair bit of hydro in up north in Vietnam. What is the constraint is how do you go beyond that 20-25% of the installed capacity in the grid, right? And the big initiative that has happened now is a power import project and connecting the grids. So if you can get the ASEAN grid going, that's what's happened in Europe, for example. We're talking of 4 gigawatt of import happening into Singapore from Indonesia, Vietnam, Cambodia, and Malaysia. And some of these initiatives will actually help decarbonize the region rather than a country. And this will be important that collectively, if we can work, we can decarbonize much faster than independently each country working. And that is something which is very, very powerful.
Interesting, because that's been part of Europe's plan, has been to interconnect, as we heard earlier. The Norwegian fjords are the greatest battery store we've got, certainly in the UK. You know, when the wind isn't blowing, we need the Norwegian fjords, so that's a really interesting point for Southeast Asia as well. Ayo, can I come to you? And Nigeria, hugely important energy producing country. Give us the perspective from Nigeria in terms of how your clients are approaching the energy transition.
Okay, thank you very much, Simon. To actually answer that question, we need to look at the structure of that industry in Nigeria. Today, in the upstream sector, the biggest player is the government itself through the National Oil Company, NNPC Limited. So you need to look at what has the government done with respect to net zero and then the other players in that sector. So starting with the government, you will notice that in COP26, the president made a commitment that Nigeria is going to be carbon neutral by 2060, right? As a fallout of that commitment, government then unveiled the Nigerian Energy Transition Roadmap. And it's a very robust document. If you study the document, you see a lot of steps that the government intends to take towards carbon neutrality. As a fallout of that, the government then enacted a law called Climate Change Act just 2 years ago. And it's a very significant act for us in the country because it tells the world that Nigeria is serious about carbon emission and that we are committed towards 2060 as sunset date for ending carbon emission. So in addition to that, the country then also decided to take this decade as the decade of gas, right? Being a transitional fuel towards carbon neutrality. That was also very significant, right? And the government is doing all it can to ensure that that is met. So, and the projection, of course, was that the country would need about $1.9 trillion US, right, to achieve that target. On an annual basis, that translates to about $10 billion, okay? And I think I'm going to come to that when we talk about the risk facing that projection. So, as a country, we also had this renewable energy master plan, which was churned out by the Energy Commission of Nigeria, of course, which has some projection that by 2025, we hope to achieve a 10% solar mix in the total energy demand. So those are the plans for the government. So the question then is, how has that translated and cascaded to the National Oil Company? Okay, not much has happened, I must say. But interestingly, earlier this year, the national company approached KPMG, right, to articulate an entire ESG agenda for the company. And part of that articulation is also the energy transition. So that's a good news. Conversations are still ongoing. We're having discussion with them in Nigeria, in London, and then hopefully before the end of this year, we're going to come to some bed as how that goes and how it pans out in the next couple of years. Now, look at it from the other players' perspective, I mean the private sector perspectives. There are also two blocks, right? First block being the IOCs who operate in Nigeria, and they have very big operations, Mobil, the Shell, and the rest. And then the other Nigerian independent players, okay? From the perspective of the IOCs, we've seen a lot of traction. In fact, of course, it's driven by their global parent policy, which is, of course, net zero. So we've seen IOCs divest en masse, right, from fossil fuel onshore field assets. It has been happening for the past 2 years. So we've worked with some of them in trying to identify what are the task rates of divestment and what are the downstream risk of those divestments. So we've seen traction from the point of view of IOCs operating in Nigeria towards net zero because they are divesting all fossil fuel onshore assets. They're getting out of that space. Now, from the perspective of the Nigerian independent players, they have a seemingly different view, and I think it's understandable. Their view is that, look, given all the projections and prognoses, fossil fuel will still constitute a significant portion of energy mix in the next 20 years. IEA, OPEC, all believe that. So they're asking themselves, are we going to fold our hands? Definitely not. So let us enjoy the music while it is on. So they are the ones picking up those assets from the IOCs and working them, although at low-cost model. So you've seen so many Nigerian independent companies picking up those assets and working them together with their Nigerian counterparts. And it's quite interesting that, for some of the oil service companies, they've had the not-so-good story of it because you've seen bookings reduced, you've seen contracts renegotiated to the barest minimum cost. So it's a mixed bag, I would say, but I can pause here while you take other questions.
Yeah, this is fascinating. I think the listed companies under huge corporate pressure, having to disclose everything, and then the smaller independents can come along and operate those fields, lower cost, and maybe quite without the same level of scrutiny or investor pressure. So fascinating story, thank you. Trevor, we'll take a long-haul flight from Lagos to Perth. Let's start with your global mining perspective. As you said at the start, it all starts with metals and mining. So how are they approaching the energy trilemma?
It's really interesting because the world has really done the math. It's understood what 1.5 degrees needs in a carbon reduction solution. It back solves for the number of batteries it needs, wind turbines, solar farms. And then it starts to do the math on what it takes to build all of that infrastructure globally. And then it starts to turn to the commodity markets on where are we going to get it from. And that is now starting to really hit the road, Simon. The conversation around what constrains and what gets us behind the curve on the energy transition will come down to the availability and the timing of minerals. And it's been really useful to have critical mineral lists. It identifies which of those are more critical than others. But there's going to need to be more collaboration globally to access those reserves and resources than putting them on a list, and that will require significant amounts of policy compliance around some of the jurisdictions where those resources sit. Thankfully, we know where those resources sit, and if you look at some of the publications from the World Bank over the last couple of years, there's been some really good work done on what our global endowment across the Earth crust looks like for these key minerals. So we've done that work, we know where it is, but bringing it on stream in the time frame that the world's going to want is impossible at the current level and rate. A couple of examples that'll just bring that to life. And it will also go to the story of capital and how capital needs to flow to the sector. We've all heard the stats on copper. It's a 23 or 5 million tonne per annum business at the moment, industry. It needs to be just under a 50 million tonne per annum industry by 2035. Lithium is about a 1 million tonne per annum industry at the moment. It needs to be a 4 million tonne per annum industry by 2035 to supply what the world needs. If you look at somebody like Rio Tinto, they've spent 15 years and $15 billion getting one project to a place where it'll supply about 500,000 tonnes of copper into the market. And so the exponential growth that's required and the time frame to bring these significant deposits that will make a difference into the world is about 10 to 12 years. And so to really turn the dial, significantly more capital and policy imperative by governments to enable activity in this space is required. When I look at the market cap of Apple, now it's a wonderful company. We all love our iPhones. It's $2.8 trillion. And that will buy you more than the 25 largest mining companies on the planet. And you might say, well, so what? So those mining companies hold the endowment for the majority of the minerals that we're going to need, but more than that, the expertise that the world is going to need to access deposits going forward. And so whilst we continue to send capital into interesting places that will give us more pixels in our camera, or remember my coffee order in the morning, ultimately there's going to need to be more capital flowing to the sector to access the sorts of minerals we're going to need.
If anybody hasn't read Ed Conway's book, Material World, I'd certainly recommend it because it makes exactly those points, Trevor, in terms of where are we going to get exactly all these minerals from that go into the products of the future. I'm going to open up to the audience for the second polling question, if we can have that now on the screen, please. So please get your phones out again. And the second question is going to be about what you believe is the biggest drivers of the clean energy transition. So earlier we were talking about risks. This time we're asking you to comment on drivers. Now it'll be interesting to see whether the answers match what we had on the first question or whether we get a different set of responses this time. So you've got government policies, is it financial returns, is it investor pressure and ESG considerations, technology and innovation, or public opinion that's the biggest driver for you on the clean energy transition? And votes are coming in now. It's neck and neck between policies and financial returns. Fairly consistent. Who would like to pick this up? Trevor, do you want to come in first?
I think they were my 2 points, actually. It's a fascinating, the government policy and risk. When we look at the deposits that are in Africa, and if you like, not even just Africa, but the fractured nature of where the critical minerals of the earth reside, unfortunately, they're not neatly in one place. They are in many, many countries and held by many companies. And so in order to accelerate and turbocharge our ability to access them, somehow we need to get increased collaboration across the vast array of countries and companies. And we certainly need to be able to prioritise those that can make the biggest difference in the shortest space of time. And you've got to call out countries like the DRC, who hold vast reserves of critical minerals, but also throughout South America as well. And so the prioritisation of solution and capital to those parts of the world could go a long way to speeding up the solutions for energy transition.
If it's possible, I'd like to bring our global head of decarb, Mike Hayes, in, who's at the front here. If we can get Mike a mic, excuse the pun, then thanks, Apurba. Mike, I'd be interested in your reflections on this, because at the end of the day, we need there to be investable propositions that are delivering significant returns. We've seen some of the recent auctions for renewables, difficulties in terms of getting investors to follow through. We had no offshore wind contracts issued in the latest UK auction recently. Give us your perspective.
Yeah, well, I want to link the first two, and the same was true of the risks in your previous survey, I don't think government policies and financial returns are two different things. I go back to Angie's opening comments. The Inflation Reduction Act, I'm going to go even further than you did, Angie. It is the most powerful piece of legislation I have seen in my 25 years working on renewables and energy transition. You quoted lots of facts and figures, but I'm going to add one. The Inflation Reduction Act is capable of covering in excess of 50% of the capital cost of new projects. I'm thinking of things like CCUS, e-fuels, mobility, ethanol projects. It's phenomenal what it can do. And there is a classic example of where government policy is, A, it's going to drive the industry, but B, it's going to materially influence financial returns. The reason the IRA so much is I've been working on what we used to call tax equity transactions in the US. You couldn't do a renewable transaction in the US unless you entered into a form of a tax equity transaction. Really complicated tax structures, partnership flips, sale and lease back to get access to investment tax credits. The reason that piece of government legislation, the IRA, is so important, it's simplified everything. We used to go through horrendous structuring considerations to monetize credits before. Today, you just sell them in the market. And I think what the US government has done, it is not only a powerful piece of legislation, what I love is so simple. If I have a project and I know I meet the conditions, I get the benefits of the IRA. I compare that to what we have in Europe with the EU Green Deal, which is an absolutely fantastic, they're not competing, but they're, you can access both of them. The European Green Deal, which has got over $1 trillion of incentives, but the sheer complexity of accessing it makes it really difficult. And most of the clients I deal with have no real appreciation of just the vast benefits. But so for me, Simon, government policy is a driver of the financial returns. I'm also a little bit surprised that investor pressure didn't come up higher. And I certainly was hovering between the first three of those. Investor pressure is becoming a really powerful thing. And I said to you last night one thing, there's no going back. This is a question of when, not if. So investors are really understanding, and Apurba, you're right in the center of this, dealing with the corporate ESG world. Investors understand are starting to understand the underlying financial risk with their investments. And that is saying, they are now saying to the corporates that they invest in, you have to decarbonize, and any major corporate, particularly industrial corporates who are decarbonizing, they have to embrace the energy transition. So what's happening, we've focused a lot this morning on the supply side. The demand side, which will really help push the energy transition, is a really powerful thing. And I go back to what Jennifer said earlier. She mentioned, and I'm really delighted she did, the First Movers Coalition. Government policy isn't always about providing money. It's about putting in place mechanisms to enable it. And the First Movers Coalition doesn't offer money. It's really a whole grouping that John Kerry initiated at COP, just prior to COP27, to put pressure on the large corporations to become the initial buyers of these emerging technologies. And guess what? It's worked. The initiative has taken off, and one of the big areas that the First Movers Coalition focuses on is CCUS and carbon removals. I mean, it's these type of initiatives that are really going to drive the energy transition for me.
Thanks, Mike. That's really helpful. And certainly from a UK perspective, I certainly share your view. The corporates feel as much pressure bottom up from their investors and their shareholders as they do from government policy right now. I don't know if, Angie, you want to comment from a US perspective. How's that balance between its shareholder pressure, its investor pressure, as opposed to government policy that's driving change?
Well, it's interesting. I remember back in 2018, so this was a few years before COVID, Mike and I met up in Singapore, and as he was sharing his perspectives around climate, et cetera, I said, I have to fly you to Houston and share this with my client because we don't hear this in Texas, in oil Texas. So Mike came down to Houston for one meeting, for a day of a meeting, and we were in with one of the major, largest oil companies in the world. And we were sharing this, and they said, I hear what you're saying, but I don't think the market cares. And Mike then went through the financial implications of their largest institutional investors and the risk that they bore around massive floods, catastrophic losses, et cetera, and how that impacted their entire portfolio. And we walked out of the meeting and I said, Mike, I'm sorry, there's an opportunity here. I don't know if they heard you. And he said, oh, they will. They will. And it took about, I don't know, Mike, what, 3 months? And the phone rang and they said, remember that guy you had with an Irish accent? We want him to come back. But I think the investor pressure is critical. You have to have the government policies supported by it. But then there's the financial drivers. And the financial drivers for new energies may play out over time. But there's also a financial return of the risk of not doing something. And I think that's key as well.
Does anybody else want to come in from the audience on any of these points we've been discussing? If not, I'll ask my panel for some reflections on this balance between the investor pressure. How does it feel if you're a corporate? Apurba, can I come to you? In India, how does it feel if you're a corporate now? Are you getting that kind of investor pressure, banks, insurers, shareholders? Are corporates starting to feel that pressure on their ESG credentials?
Absolutely. And I think, we've had clients in the heavy industry sector, even, for example, clients asking us, because the investors are asking what is the embodied carbon within a packet of, say, sugar that they're exporting to European countries. So that investor pressure is huge, and while I agree that has been a major driver, but with respect to your last question, I was just wondering that if it was just investor pressure or ESG considerations, and if there was no policy push, would we still have gotten there? And perhaps we would have, but we would have gotten there at a much slower pace compared to what science demands, right? Because if you're looking at transformation at the scale and pace that science demands, you do need that, I think, policy push to be able to mobilize all of the resources fast enough to the right sectors. And I think that's where, the policy piece also is a very critical one in the whole puzzle.
I'll just 3 points to that. So I agree with the broad views from the audience. So on the government policy push, I think it's extremely critical. Political will is very, very critical to implement the agenda for clean energy transition. And we have seen that why is Thailand, Vietnam, Philippines successful and why Indonesia doesn't have much of renewable. So that all comes down to government policies. And the second point on financing, and I think the marginal technologies will definitely require first loss capital. And we are working on a geothermal plant in Indonesia. It's very clear that whatever is commercially viable, onshore wind, solar, will get implemented. But all the marginal technologies will struggle unless we get some blended financing there. So that is going to be the second important thing. The third point to my consideration is the ESG aspect, particularly with the technology companies. So all the semiconductor manufacturers, data center operators are actually pushing the agenda to procure, as per RE100 commitments, get 100% renewable energy. And this is becoming very important, in particular in Southeast Asia with the China +1 policy globally. A number of manufacturing companies coming into Southeast Asia are insisting on getting clean energy sources. And that's led to a lot of corporate PPA kind of activities in the region. So those are the big 3 aspects to my mind.
So I was just going to add one thing from the mining industry's perspective on ESG and the impact it's having on them. ESG and shareholder pressure has been such that they've recognised the need to participate in the solution to Scope 3 emission reduction. And what that's done is diverted significant amounts of funding in mining companies to support the major steel mills of the world, working through R&D solutions to capture that 10% impact that's possible by taking carbon out of the steelmaking process. So BHP, Rio Tinto, the major steel mills of China are actively collaborating with significant amounts of money to try and accelerate the solutions to Scope 3 emission, and that's come from ESG pressure.
While you've got the mic, Trevor, let's go down with any final concluding thoughts from our panel. I've been told by Anish I have to finish this one at 1 o'clock on time to get everybody out to lunch. So to start with Trevor, we'll work our way back down the panel. Any final thoughts on this discussion?
Well, I think from my personal perspective in the mining space, Simon, there hasn't been enough focus yet on what will ultimately be the handbrake to the speed at which we can decarbonise. But it's coming. The mining industry knows it's coming. They're struggling to be able to meet what that demand looks like. And so I'm looking forward to government policy, capital markets and others really starting to lean in and support that industry, supply what the world needs.
Yeah, at the sake of repeating myself, I'd say, just wanted to highlight that, finances, because I think for a lot of the sectors, the price differential in terms of your, product, what a company is manufacturing, hasn't developed to the extent that it can justify a lot of the investment that we need. And that's huge capital cost in the energy transition, specifically for corporates. So I think it's very important to enable finance, not just ramp up what is committed already on the table, but even just to mobilize, what is committed already and then ramp it up further. And I'm hoping that this COP perhaps will give us a new, finance deal that enables and pushes it in the right direction. So I'm really hoping for positive momentum on the finance front at the end of the year.
Thank you. Sharad?
So to answer the question, are we falling behind the curve? I must admit that we are definitely experiencing a lot of headwinds, economic headwinds, geopolitical headwinds, as well as challenges on financing and technology breakthroughs, right? What would happen going forward, to my mind, is if collectively all the people can come together and make all these three things available on the table, which is innovative, cheap financing on the table. I think we should work in partnership with private sector to get the technology innovation going. And hopefully the high interest rate environment and the geopolitical risk that we are seeing will subside over a period of time. And then that will give us the momentum to move towards our goals.
Thank you very much. I think for Nigeria, my final comments would be to say that if, like I did say earlier on, we need a sum of $1.9 trillion, right, to achieve net zero by 2060. And that's about the same amount that the World Bank says we need to fix our infrastructural gap for the next 20 years. We're at a dilemma. So if you have that money, the prognosis is that perhaps the government may likely go for infrastructure as opposed to energy transition. And that's why the comment made by Dr. Ajir Bathur earlier on is very, very important here. We need that foreign capital. Otherwise, it might be a mirage to achieve that net zero. So, are we falling behind the curve? Yes, but we're on the journey based on what I said earlier on. We have structures in place to do that, but foreign capital is key towards achieving net zero. Thank you.
Thank you.
The one key learning that I would share from the IRA that has made it beneficial is, we say in the US, carrots versus sticks. So being able to offer incentives over mandates, having something that is private sector led but government enabled has really been beneficial. And if you structure your policies in the right way, the investment will come. 60% of the IRA funding has gone to corporations located outside the US. So that would be my challenge for our international community, is think about your policies and regulatory structure to entice.
So let me just try and sum up a few of those thoughts from our excellent panel. The world is definitely not on track. I think we are falling behind the curve, but there is reasons for optimism, because we've just heard about one of the biggest dramatic changes in policy that's changing the balance in terms of what the US has done. And I like your point about carrots and not sticks, Angie. I think that's really, really positive. We heard from Mike about the combination of how policy can change what's investable very quickly. And we've heard, from Apurba and others about the ESG considerations growing and growing in terms of corporate behavior and in terms of pressure. And from AO in terms of the importance of foreign capital, and Trevor in terms of those tipping points for the mining community as you get to that sense in which it's really starting to bite. So there are reasons for optimism, actually, and I've really enjoyed our little tour around the world on our sustainable aviation. So I just want to say a big thank you to my excellent panel for taking part in the discussion. Thank you very much.
No, I'm going to...
1 o'clock on the dot, Anish.
I'm tempted to say this. Suggest that we had strategically made Simon the moderator on this panel, because whenever we start, we know that he will finish sharp on time. So you have done that. Thank you so much. Let me invite all of you for lunch, and we come back